So once again, good evening and Assalamu alaikum to everyone. Thank you so much for coming on this webinar. And I think a lot of people are joining, but then we'll start our sessions on time. As I said, my name is Yogesh, and this webinar is powered by Century Financial. We are an investment consultancy, and we conduct research and trainings for investors who wish to invest in financial markets. And we keep doing these webinars week on week, months on months, and the idea is to keep you informed and aware about how financial markets work, what is the current investment trend going on, what are the risks in the investments, and that being said, there are multiple factors which may affect your investment, and most importantly, there are so many strategies which investors of all kinds, conservative, aggressive, moderate investors, they undertake. And today we are going to talk a bit about a mind shift in the financial markets, understanding the practical skills of navigating through the volatility. We're also going to talk about a product called the Volatility Index, and how we can take advantage of the movement in the financial market. We are going to talk about how volatility can present itself as an opportunity. And before we proceed, as I said, that if you can hear my voice properly, if you can see me, if you can see my presentation, please use your chat options. Write yes or okay. So this way you will be able to test your chat options as well. And let's try to make this more and more interactive sessions. Obviously, it's just me talking, but you can always type any questions you have in your mind. And while I'm doing the session, I can answer a few of them. And once I end my session, I can definitely answer all the questions I can. So I think everybody has started. Okay. Yes. All right. Okay. Perfect. Perfect. I think most of you have already replied. So that's great. Now, the financial markets are full of uncertainty. It doesn't matter how many analysts and researchers they sit together, they put their heads together and find out investment ideas. There is always an element of surprise which comes in, and that is the reason that why we need to diversify, why we need to allocate our money to different asset classes, and we need to know and understand about how these asset classes work, how these different financial instruments they move, what is the trading range, what is the movement range. And some of you, I think a few questions have already been asked here. So somebody just talked about that, is day trading only available in forex, or is it something more than that? Definitely. When we hear about day trading, we hear mostly one asset class, which is forex, which basically involves currencies. But that's not it. It also includes asset classes like stocks, commodities, which means gold, silver, crude oil. It also includes indices like S&P 500, Nasdaq, Dow Jones, German 40, and it also includes some bonds which you can buy sell day on day basis. And we are going to discuss one of those bonds today. And you'll be surprised to know that bonds have been known something which is more of a fixed income idea. How this is something which can be used in short term and long term. So this is something which we are here to uncover. And whatever we are going to discuss today, friends, the strategies or the ideas, this is for information purpose. If you want to act on it, if you want to execute any of the strategy you're feeling that you want to do it, please, before doing that, talk to our financial consultants, talk to the risk experts. Anything which I'm going to talk about here, any strategy I'm going to talk about over here, none of them are risk free. Every strategy contains some amount of risk, and that is why all of us are here to understand those risks and to try and see that how we can manage them well. So before you execute any trades, just try to talk to your risk experts first, and only then look forward to it. So starting with something very important, we talk about mind shifts and technique. And this is something which we have seen a lot happening among the investors. And a lot of times, traders and investors, they become slave to fear, panic, greed, and sometimes it becomes really difficult for them to take an investment decision. So what we need to do is the techniques which you're going to understand today, it's all about developing a sort of mental fort, and we have to practice skills to make more and more confident investment decisions. So the idea about most important part about mastering your mind is, and understanding this mind shift is, we have seen over a period of time, say different events, whether it was COVID, whether it was US elections, whether it was Chinese stock markets falling down, whether it was recently the Russia-Ukraine war. Every single event caused a lot of volatility in the financial markets. And it is an emotional roller coaster as well, right? Because, like, take example of the pandemic. We saw a stock market coming down and then recovering, and then again coming down and then moving. And for the next 2 years, again, we saw different movements. So some of the events are really emotional for us, and at the same time our investments are also facing that. So we need to understand that whether the stock market swings up or down, we are in this roller coaster. Even if you're a long-term investor or a short-term investor, you're still part of the swing. For long-term investors, yes, it's less volatile, but at the end of the day, you also face the risk of when the markets fall down. Let's say, for example, if somebody was a long-term investor in gold, for 10 years after 2013, gold was not able to reach to its highest price. And if I get the time, I would also share with you the chart. Only in 2020, when the pandemic happened, due to uncertainty and due to riskier situations, gold prices shot up. So that being said, even long-term investors can get stuck into a big cycle of depression, and then that can deteriorate the value of their money because inflation never stops. So we need to navigate through these ups and downs with a lot of confidence, right? So when we are talking about mindset shifts, we have to understand that while we are investing, we have to focus on the controllables. Like, that basically means that something which you can control in the market, there are few things which you cannot control in the market. What you can control is your reaction and your investment strategy. So the first point is focus on controllables, which means that focus on your investment strategy, focus on the idea of what you can control. And you cannot control what happens in the market, you cannot control the market, but you can control your reaction. When the market starts falling, you have to understand that, do I have to sell immediately, do I have to get under panic? So these kind of things, so the strategies which we are going to discuss, and we are going to go through a few strategies, and I'm going to show you that if you're a long-term investor, short-term investor, how you can deal with this. And that's why your investment strategy needs to be very strong. And when I say strong, it doesn't mean that it has to have a profit all the time. That's impossible. But it needs to be diversified. It needs to have a mix of all the asset classes, and a few of them we are going to talk about today. A quick question over here. Somebody asked, what if I don't have the time to research? Do you have people who can trade on my behalf with risk managed? So there is a concept of wealth management which requires basically managing somebody's wealth, but it's more of a long-term scenario. When you say that people who can trade on your account, that is a short-term volatile situation. By the regulatory perspective, none of the brokers or CFD providers or consultants are allowed to trade on clients' behalf. Regulators don't allow that. And this is something which is have been already talked about, because there's a lot of conflict of interest. So just to tell you, every time you place a trade, you're charged a certain amount of brokerage, and somebody who's managing your account is always in conflict of interest. So that's why the regulators have altogether said that there should be no management of the accounts by the regulated brokers. But what we can do is definitely provide you some strategies which may not require day-on-day monitoring, but medium term to long term. And we are also teaching and training investors how to put stop losses, take profits, how to place a trade that you don't have to see it every day. This is something which should not take your precious time. If you are working, you have a job to work on. Investments is something which should be done. It is mandatory, but at the same time, you should enjoy while you're doing it. It should not be something which should be too stressful. So risk management, there are a lot of ways you can do it, and you can do it yourself. That's what the session is all about, right? So moving on, first is focus on controllables. Second, what you need to do is embrace the long-term understanding. You have to focus on your long-term goals, and sometimes avoid the short-term volatility. And we have seen this so many times that when you buy a stock, for example, you realize that okay, I'm going to hold on to this for another 2-3 years. Let's talk about a company which is into electric vehicles, say Neo, for example. The stock has been beaten up, but if you have bought that stock with a vision and you're expecting that in the next 5 or 6 years electric vehicles is going to be a thing, and Neo stock is going to move higher, the short-term volatility up and down should not affect you, but only if you have a long-term profit vision that this is something which is going to make money for me. So you have to develop that mindset that maybe in short-term markets are going down, but I don't need to panic and sell everything. This has been observed so much in 2022 when markets were going down. A lot of investors were scared to actually enter, but that was one of the best time to enter, because in 2023 markets again recovered. So always embrace the long-term goals. If you see the short-term volatility, it may be a good time to enter for a longer term, right? So that is another mindset shift which you must do. Another thing is reframe the volatility. The present volatility which we see this as an opportunity to find good investments at lower prices. So if you're seeing markets are too volatile, how many times we see this? Many investors I talk to, and every time we stumble upon an idea that let's buy this, or let's wait for 1 or 2 months and let it come down. A lot of times investors, they feel that because there is so much volatility, there is so much movement up and down, and something which has fallen down too much, we should not be entering at the moment. Please remember this. You have to see volatility as an opportunity. If the market was just going up or just going down, that would not bring investors' attention. So never think that right now markets are moving too much. Once it is down, I will buy then. You cannot time the market. I cannot time the market. Best of the best researchers, traders, they cannot time the market. When you say that right now markets are up, it kind of means that you know that when they are going to come down and you will enter. Or when you say that right now markets are crashing, it tends like that when it will come down and recover and then you will enter. You cannot time the market. That's physically impossible, and that's practically impossible. So what you need to do is you need to be in the investments market. You have to be there. If you feel that markets are already up, invest small. If you feel that markets are going down, it has come down a lot, invest more. But use that volatility to find out your favorite investments at a lower prices. And again, as I said, that there are a lot of strategies which we are going to talk about before the session ends. So just stay with me. We're trying to build a momentum and understand that what sort of mindset shifts we have to do. First, we have to focus on something which we can control, which is our investment strategy and which is our reactions. Second, we have to embrace the long-term goals and avoid the short-term volatility, or not get bothered by the short-term volatility. Third, we have to see the volatility, the movement, the up and down movement as an opportunity to enter into investments which have come at a lower price. We should not be too scared. Lastly, the mindset shift which we need to do is about accepting the uncertainty. We have to acknowledge that there is some level of uncertainty in the market. But again, that should not stop you from entering. As I speak with you, I'm sure anybody who's listening to me, somebody who has traded, somebody who hasn't, everybody has faced a failure or a loss, sometimes in financial markets, sometimes in stock markets, day trading, in your business. But that should not keep you out of everything. You have to embrace the fact that you have to accept, acknowledge there is uncertainty. What my job is to navigate through this. How I'm going to do this? I'm going to accept that markets can be uncertain, markets can move crazy. So what I'm going to do is invest into different products. Some of them I'm expecting will go up. Some of them I'm expecting will go down. So I go long on what I feel. I buy what I feel is going to go up, and I short sell what I expect to come down. And that's how I make a mix of the portfolio. And I determine my risk appetite. Sometimes if you buy something and if you see that you're on the wrong side of it, this is especially for the short-term traders I'm talking about, that when you enter into a trade and when you see that you have gone on the wrong side of the trade, don't wait for that to recover. If you're a short-term trader, you know that by the end of the day, your trend has been changed. Next day, new trend, new trade. And that's how you have to close your positions, accept the loss, and move on. You have to accept the uncertainty. I know that easier said than been done, but that is something which happens a lot. Moving on to practical skills. Now, this is where we understand. So, what we see is that there are mindset shifts which we have to do. And once we do that, once we are able to do that, next thing is we have to identify practical skills, that how we should, what sort of techniques we should use after we have that mindset shift. Firstly, it's diversification. Then there is research, there is patience, there is risk management, and the center of all is the discipline. So, what we need to understand is diversification is all about different asset classes, which means you put your eggs into different baskets, right? We keep hearing about this, and this looks like such a common thing. But the idea is that you should not invest into just one particular product. I speak to so many investors, and it's been 15 years I've been a part of this industry. I have spoken to so many investors, consulted so many of them, and I have realized a lot of investors develop favoritism towards a specific product or an asset class. So many times I meet people and they say, I only invest in real estate because that's what I know, that's what I've been doing, that's what I've learned from my father. And no disrespect, that's actually very good. But you have to understand that money invested into one asset class would result in either profit or loss or a delay, right? When markets are going down. Now, with real estate, it's very simple. You buy a house, you probably give it on a rent, or you hold on to it yourself as an investment. Now, if the prices go up, everything is very good. But if the prices go down, now you have your house, and that's a physical asset with you. But that is just telling you that, okay, I cannot sell it right now because prices are down. You know what will be higher that time? Probably commodities, probably bonds, probably stocks. Any of those things can be on the higher side. So you must understand that diversification is really important. And I'll tell you a bunch of strategies together, that how you can diversify into different markets and how you can use these different products to make a portfolio, right? Second thing, I think somebody over here asked about that, if I don't have the time to research, can somebody trade on my behalf? Research is important, but when I talk about research and knowledge, you just need to be informed. I think this is one thing which a lot of traders feel, that probably they are missing out on something because they don't have the understanding of the balance sheets. They don't have the understanding of the fundamentals or technical studies or charts. Let me tell you this thing. This is a myth that only professionals can do this. Uh, all you need to do is just be aware about what is going on. Now, that awareness does not take a certification. That awareness does not take years and years to understand. Let's take a very simple example. Today, if you drive a Toyota or a BMW or a Tesla, Ford, Volkswagen, if you eat in McDonald's, KFC, if you have a debit card or a credit card which says MasterCard or Visa, if you have a iPhone or a Samsung, if you have, if you're using a Johnson and Johnson's product, if you're shopping from Walmart, all, if you have a Netflix account, if you have a Facebook account, if you're doing this communication, your meetings over Zoom, all of these companies, they're listed in stock market. You're using their products. Probably you're not investing in them, right? Which is part two. Second thing is, you're not aware about what's going on with them. What's going on with McDonald's? What's going on with KFC? What's going on with Johnson Johnson? And all it takes is you type the name of the stock, Google it, and click on news, and you will see the first line what's going on. And it's not technical. It's all about how much revenue the company is making, what happened to the stock, and that is all. You don't have to be a financial analyst to be a good investor. Please understand this. There are millions of investors in this world, and not everybody is a financial analyst, right? Not everybody is a market technician. All it takes is to just be aware about what's going on with the companies whose product you're already using, and over a period of time you get to see the prices and you enter. This is something, and I'll tell you a very easy way to do this. I'll share the live platform with you while we are discussing in a few moments. And when I'll discuss this and when I'll show you the trick which I'm using for myself, and a lot of interns, I fortunately go to a lot of universities and speak to a lot of students, and I have given them this idea that, apart from all your studies and certifications, what you have to do, try this out, and this is definitely something which is going to work and give you the knowledge which is very, very important. And I'll share that very important research tool with you. So while we talk about research, this is not something which you have to have a certification. All you need to is just be aware of your surroundings, and I'll tell you a very easy way how to do that. Next is risk management, of course. Um, for day traders, stop loss is like a bread and butter. It should not, in no case, that stop loss should never be put. And you have to understand your risk tolerance. Any trade placed without a stop loss on a short term period, it's a suicide. I mean, you might end up on the right side of the trade, but I have observed not putting a stop loss leads to a major, bigger loss. So you can explain to yourself that, every time I put a stop loss, it touches my stop loss and bounces back. Understand that's frustrating, but not putting a stop loss, that is not an option. You must always put a stop loss. For those investors who have not known about the stop loss, anybody who places a trade in the trading platform, if you don't have the time and you're not looking at the trade throughout the day, all you can do is put a barrier, and if the price comes down to that barrier, your loss is automatically booked, whether you are looking at that trade or not. So a lot of traders and investors who don't even have time to look into it, they prepare these order tickets, they buy, they put a stop loss, they put a take profit, and whichever comes first, it gets hit. And that is the reason why there has been an increase of a lot of traders and investors who are using the platforms these days, because most of the platforms are now very equipped with all these important tools. And again, patience. You have to have patience. You have to have discipline, because consistency, discipline, patience, these are the very important tools for a trader. You should not get overconfident. Sometimes you buy something, it works really well, you do it thrice or four times, and then you feel that you know how market works. Trust me, I have lost a lot of money just by being overconfident, and had to learn the hard way that that's not how market works. So we have to be very careful of the financial markets. We should fear the market. Fear is good, but also we should not be too averse. We should not be too fearful also, but we should not be too overconfident as well. So we need to have patience and we need to have discipline. Discipline means that if you have decided that you have to do four trades every day, and you have to invest into, so your long term investments should be kept separate, your short term trading should be kept separate. Never have the same thing in the same account, because one is a margin trading, one is the leverage based account which has high risk, high rewards. Another should be the long term investments account, where you should hold on to your assets and wait for bigger gains, wait for longer durations. If you have a target in the in your mind, that target should be achieved, right? The risk reward should be equal. So there are a lot of these investments which you can do. And again, as I said, that over as we move forward, we'll definitely are discussing these particular strategies as well. Please continue to ask any questions you have. And so I think one more questions here. Many platforms have found to be running stop loss targeting algorithms. How do you cover for that? See, again, for everybody, the question which has been asked, that there are so many trading platforms who are running the stop loss targeting algorithms, which means that if a trader puts a stop loss, there are algorithms set that they identify the stop losses, and the markets come down and hit it and then bounces back. I do not deny that there is a lot of manipulation which happens, and to feel that every platform is doing that is not right, because there are a lot of platform providers which are oldest in the market. That's why a lot of times we are being asked why you're so expensive, why you have spreads, why you have commissions, why you have holding cost. And my answer to everybody is that at this point of time, uh, the market we are in, I don't think that cost should be your deciding factor. Please don't choose your investment provider by the cost. I know cost is important, but you have to understand that choosing one platform over other just because of a certain cost is what increases the risk. All these platforms which you're talking about where the algorithms come in, these are the platforms which invite you with zero commission, zero spread, zero cost, right? How will they earn money? This is how they earn. So that's why you should stick to the brokers, to the platforms which have the vintage, which are old enough to bring that level of trust, which are regulated under Securities and Commodities Authority over here, which are regulated by SEC, which are regulated by FCA. The importance of regulation is what we need to do. Otherwise, there are a lot of such platforms which are using algorithms, and the most easier ones are the meta traders. That's why every single other broker uses meta traders very easily, because they can be easily used algorithm into. But that is market manipulation, right? That is not something which is right, and not everybody does that. But your question being acknowledged, yes, if something like this happening, you need to be very careful. Still, you need to put a stop loss, because if your stop loss gets hit, that's a loss which has been booked. There will be another day, there will be another asset, but that being said, you have to put a stop loss. There is no excuse for that. I've seen enough people losing enormous amount of money when they don't put a stop loss. So it will take a lot more for me to say it out loud that you don't have to put a stop loss. So yes, we'll try to understand that when we are placing the trades and when we diversify enough. Trust me, putting the stop loss is not the worst thing, because we are diversified into different directions, right? Moving on to the strategies part. Before again, strategies is going to be the most important part of this session, and once we discuss all this, if you have any questions, please you can ask. There are different level of strategies for different risk levels. There are different kinds of traders, investors. Everybody has a different duration. I'll start with something more towards bonds first, and then move on. We'll see how to take advantage of different events, right? Let's start with something which we have been and this is something which is much more fresh. Again, there's a question also, that how we decide the stop loss. Very good question. Once I discuss the strategies, I'll go to the live platform and I'll show you that while we are placing the trade, how to decide the stop loss. Deciding the stop loss is also connected to identifying that what is the average movement in an asset class, and I'll tell you how you can identify that. So now when we are looking at the strategy, the first strategy which we should look at is US Treasury Bond Ultra. Now there are different asset classes. Stocks, which are basically companies. Stocks are also called shares, or as we known as equity market, stock market, shares market. It means the same thing. So there is one asset class which is called stocks. There is another asset class which is currencies. As we know, euro dollar, dollar yen, pound dollar. There are a lot of currency traders which buy and sell. There's one asset class which is called stock index, right? So those who are from India, you must have heard Nifty 50. Index is basically a benchmark which measures the average performance of a bunch of companies and give us the idea whether the stock market of that country is up or down. So if I say Nifty 50 or India 50, that means that I'm looking at the average performance of 50 Indian companies. And if the average performance is higher, prices are up, you will see the index also rising. Similarly, every country has a stock index. There is S&P 500 for US, there is German 40 for Germany, there is Hong Kong 50 for China, and like this, there are a lot of other indices, right? Now, this is one asset class. Another is fixed income, which is also called bonds. Bonds it just works like how banks work for us, right? When I take some loan from the bank, I have to use that money for an X amount of time, as much as let's say I take a 10 years loan. So I will use that money for 10 years. And after 10 years, I have to pay that money back to the bank. Until the time I'm using that money, I have to pay interest. Bonds work exactly where you get to be the bank to someone, right? And mostly it is the US government or the government of the countries. So if US government issues a bond, like a bond certificate, and you're buying that bond certificate, basically you're giving loan to the US government. They will use that money. Until the time they are using that money, they will pay you an interest, which is called coupon. Now, interest factor or coupon factor, from an Islamic perspective, some of you may not like it, and that being fair. So there are different ways of investing into a bond. One is through a derivative, one is through that actual bond which you buy as a certificate and you receive a coupon over it. Whatever you like. Currently, a 1 year US government bond is giving you a return of around 4 to 5% because interest rates have gone up. So anybody who is investing into fixed deposits in your countries, here you can buy a government bond and you can earn 4 to 5% a year in dollar terms. So that is one sort of investment which you can do. Currently, so let me quickly share the recent flyer, which I'm going to do this. Here, let's say, okay. Here, I hope everybody can see this, right? We are talking about, and this is the strategy which has come today. So I will start with this, particularly US Treasury Bond Ultra Recovery Roadmap. Today, we are going to talk about a US government bond. A US government bond. US government issues bonds so that they can borrow money from people, use it for economic activities, and while the time they are using this money, they will pay a coupon or an interest to the investors. A lot of you can buy these bonds using the platforms and receive coupons over it. And sometimes these bonds, they rise in price. So for those people who don't like to earn coupons or who do not like to receive interest in their accounts, you can play this over a capital gain. You can buy this, and if the price goes up, you can sell it in the market as well, right? And that you can do using a derivative based platforms, and we provide you both of them. Now, how we are looking at the bond, US Treasury bond at the moment. Let's understand what the product is. So at this point of time, this is so Treasury bond ultra. There are two kinds of bonds. One is a short-term bond, one is a long-term bond. And when I say long-term bond is the one which you have purchased, which will mature in 25 or 30 years. So obviously, the interest which you receive on those bonds is connected with the interest rate which the central bank charges to the commercial banks, like the lending rate. That lending rate can also decide the price of your bond. So if you buy a bond at $100, which gives you 6% interest in the market, if the interest rates get cut to 3 or 4%, that will increase the price of your bond because you are getting 6%. On the contrary, if you are receiving a 6% interest on your bond and in the market interest rates go up to 7 or 8%, the price of your bond comes down because the bond certificate which you have, it is giving you a lower interest than the market. Now, as we speak, the product is the 30-year bond, which is giving 6% interest, right? Now, look at the price chart of this. Look at the price chart of this bond. So everybody, please, if you want, obviously, somebody just asked the question, will we be able to get this PDF? Yes, definitely. You will be able to get this PDF also, but keep a notepad or a diary with you while we are discussing this. What you're seeing right now, friends, this is a price chart of a 25, 30-year maturity worth bond, right? When I say 25, 30-year maturity, which means if you buy this bond gets matured in 25 or 30 years, which means you are giving loan to the US government for 30 years. But that doesn't mean that you cannot sell this bond in the market. You can. So there is no lock-in period over here, right? So right now, when the bond price which you're looking at, if you're buying this bond at $100, you are buying this bond at $150. At this point of time, the price of this bond, if you see this chart, let me expand this a bit. I hope everybody can see this. Currently, it's $120. $120. If you see back in 2020, when there was pandemic and interest rates were almost low, the price of the bond was around $220. Currently, it is on 120. What was different in pandemic? Interest rates were down. Because interest rates were down, the bond prices were higher. But after 2020, when markets reopened, inflation skyrocketed because everybody who was in shutdown or in the lockdown, when they came out in the market, everybody started demanding more raw materials because they wanted to compensate for the amount of time which they lost. So the manufacturers, the producers, they doubled the demand for the producers, doubled the demand for the raw materials, and we saw prices sky going up. Then there was a Russia-Ukraine war, which also created inflation in a lot of agro commodities. Energy prices went up. So when inflation went so high, central bank had to make loans more expensive so people cannot borrow more money. And that's what brought the bond prices down. So look at this from 2021. This, which was $200, the treasury bond, has come down all the way to 140, 130, and now 120. And look at this. I'm showing you the price movement since 2010. Look at this. So this is the support line where it has found. In 2010, the treasury bond ultra was $120. And after that, recently in 2023, it went down to 110, and now in 2024, it is at 120. Now, there are two classes of investors over here whom I'm addressing to. One, who are okay to get an interest over this. So for you, you can find out any platform which can give you the actual bond, I would say bond certificate, but these days everything is electronic. But you can actually own the bond and you can buy it and you can earn 5 to 6% coupon on this. That is one class of investors. Now, for those investors who would not like to receive any interest but want to take a play on the capital gain, a bond price which was $200 in 2020 now has come down to 120, right? And this was 120 in 2010. So it's been 14 years since it has seen this price. Now, if you want to buy this, hold it for a longer term, you can. If you want to buy and keep it for a shorter term, the moment it goes up, you can close your trade and get out of it. So this is for every class of investors: short term, medium term, long term, somebody who wants to receive coupon, somebody who doesn't want to receive coupon. But look at this. These are the opportunities which nobody's talking about, right? When we hear about bonds, is what we know through banks, that you buy this bond, you're going to get interest. But what we also don't know, that there is a way that you can just play on the price. If it goes up, you can close your profit. If it goes down, there are a lot of investors, when it goes down, they buy more because this is directly connected to US government. Right now, interest rates. So talking about, somebody asked the question that what is the current interest rate and what is expected. So as of now, inflation in US did come down as compared to before. That being said, still slightly on the higher side. Central bank has been very open about its intention to now reduce the interest rates, which should push the bond prices higher. So as I speak, also I must show you that once we have seen the chart. So let's see what else we have to see. Now the US bond currently trading at 120, not too far above its low recorded in 2010 and 2011. The bond hit a low of 109, high of 142 in last 52 weeks, right? And this is the chart which we see. So there is an opportunity where it can go to 136 or 140. This is the current range. And you must know that average, so this is for my short-term traders, average trading range daily in this particular product is around $2 to $2.1. So it gives you a volatility of around 1.5 or 2%, right? Now this is up to you. You want to do it short term, you want to do it long term, it's up to you. But on daily basis, this is moving around $2. So it's up to you. You can decide your quantity or you can just hold on to it, wait for the prices to go up. This is up to you. So this particular product is for every single investor and you can play it as you want. So what is now, this is something which is really important, guys. Click a picture if you can and understand this. There is something called a regression analysis, which is done through technical analysis, through a lot of researchers. A lot of fundamentals also are being used just to understand the relationship between the long-term bond and the interest rate in the market. And when we do regression analysis, we just try to find out that how much impact there will be on the bond price if the interest rate was to go down or was to go up. So as you can see, after the analysis, what we've understood is that if the interest rate comes down by 0.5%, 50 basis points means 0.5%, we could expect a price increase of around 8.9%. And if the interest rate come down by 1%, we could expect a price increase of 17%. On the contrary, if the rates go further higher, we could expect a decline in the price of 7 to 15%, depending on how it goes down. So there is a risk and reward right in front of you. You decide what you want to. Both the scenarios are with you. If I were to see the current status of the US market at this point of time, central bank is very open. They have said that they will cut the rates. Traders are, or analysts are expecting a rate cut in September. Again, that depends on how the data comes in. But if the rate cuts happen, these are the numbers which we have received through regression analysis to identify that if there is a rate cut of 1%, there could be an increase of 17 to 18% in the treasury bond prices, right? And they are linked with the interest rates. That's what bonds are. So over here, you can assess your risk. You can see that if a product is moving $2 a day, I can do a trade, or I can just buy and hold on to it because it has come up with at such a lower level. So I can just buy and hold on to it and wait till September and see what happens, right? So this is something, and again, this can be a part of your portfolio. You don't have to exhaust all your savings and put into one product. That's what I meant when I said that you must diversify. Now understand that this is one product which you can diversify into, right? Going forward, when we are looking at this regression analysis and checking inverse relationship between the treasury bond ultra and the 30-year interest rate, if the yield declines by 0.5%, bond price is expected to go up by 8.9%. And as I said, that if yield comes down by 1%, it is expected to go up by 17.2%. And that's where now there are two ways to do it. There are a lot of investors who see these bonds because the volatility is less. There is a way that you can use derivatives platform and take 2 times leverage on it on a conservative side, or you can just do not take a leverage and keep the position for a longer period of time. This can be done by any trader or any investor, and you can choose the amount. Somebody just asked that what is the minimum amount to go ahead with. So there is no minimum as such. I think there are a lot of platform providers which start this from as small as $1,000, but that's up to you that how much investment you want to do in this. But there is something for everyone. I mean, even if you're making $1,000, $2,000, this is a US government bond which is giving you a certain amount of interest already, and it is down at a current price. So some of you can earn capital gain and interest also, both ways, right? So again, risk is that the price might drop, right? But the product is a US government bond, so the volatility scale is less. None of them is risk-free. Please understand this. Everything has a risk. Sometimes it's low risk, sometimes it's relatively higher. So you just have to understand that part. And just to give you an idea, what is the Federal Reserve looking at? They have kept their interest rates at 22 years high. The interest rates which you're talking about between 5.2 to 5.5%. The Fed chairman has already said that the rate cuts can happen anytime soon, and they just need to be looking at the data. As the inflation rate reduces, the growth in inflation reduces, that is where they would do the rate cuts. Rate hike is something which is very unlikely, so there is a less chance that rates will go up and Fed will be too restricted. And markets have already factored this idea, right? So we have seen that they have already, now a lot of traders, they are pricing a 50% chance of the rate cut by the end of the year. So jobs data, inflation data, these are some important information which the central bank will be looking at. And on the basis of that, they will identify when to cut the rates, right? And again, this is a chart of the interest rates which are 22 years highest at the moment. So Again, guys, for further details, I'll send you this flyer, or you can ask your respective relationship managers how to do this, and we can definitely move forward if you are interested in this part. Before I move on to the new strategy, I'll just answer some questions over here coming in, and thank you so much for asking these questions, guys. Please continue to write more, and with every strategy end, I'll try to answer as much as I can. So. How do we decide the stop loss? Once I come to the platform, I'll tell you how to identify spread manipulation by some brokers who use this during market closing and opening when low liquidity or highly active market situations, as this causes stop outs due to low margins. So very important question. But the thing is, what you are calling manipulation is actually not manipulation. This is not illegal. So when the spreads get wider, spreads is the buying and selling difference in a product. And we have seen in a lot of CFD platforms when there is no liquidity, and that is sometimes very close to the when markets are about to close. The market makers, basically the platform providers, they widen the spreads because the volatility is less, so demand is less. So they widen the spreads and they earn more income over it. That is not actually manipulation, because that is out in the open, that it has been a very standard practice that whenever the demand is less, the spreads get wider. So there are some products also where the demand is less and the spreads are wider. So that is something which happens a lot. And during the time when there's a lot of volatility, even during that time also the spreads get wider. So what you're saying, I understand, it does hit your stop losses sometimes when the spreads are wider. That's why, again, I'm telling you, choose the platform wisely. Some platforms, they do it a lot. Some of them, they do it only when the volatility is too high or too low, right? So the ones which are older in the market, they maintain a stability, but the ones who are very new and they're looking for a very short term gains, they have these wider spreads. So just be careful, but that's not manipulation. That's actually legal by the market makers to do that. So but I definitely understand what you're saying. Next question is, can we invest in Indian markets using your platform? As of now, there are a lot of platforms which are not providing Indian markets because the quotes are not coming in. Earlier, we used to get Nifty from Singapore, but now I don't think any CFD providers is getting. But you can invest into Indian ETFs. There are a lot of Indian exchange traded funds which are available on these platforms. And a lot of people who do in Indian markets, currently in India, there are a lot of discount brokers which are charging zero commission, like Zerodha and GrowAm and others. So a lot of Indian investors are happy doing that. From our side, we can definitely provide you some Indian ETFs if you wish, and these are good ETFs. Again, they're giving you an exposure on 50 Indian companies, and some of them are trying to replicate Nifty also. So we can find out some good Indian ETFs and provide it to you. What is the brokerage? See, the commission charges are different. It depends product to product, depends on volumes as well. But we can definitely, once we can sit one-on-one, I can definitely discuss the charges also with you. Cost of leverage. So cost of leverage, also called as financing cost, or something which is also called holding cost. If you buy something and hold on to that trade after 1 a.m., you are charged something called a cost of leverage. Cost of leverage is different in product to product, and you will be surprised to know that sometimes if you are on the buying side, you pay, but if you are short selling something, which means if you're expecting prices are going to go down and you bet on the lower side of it, you receive that cost also. So again, this is something which is product to product. We can definitely share and discuss it with you over the email. Is the session being recorded? Would love a link for reference later. Definitely. We will put a recording of this session on YouTube, so you can definitely view this later. And also, everybody who's a part of this session can book a one-on-one session free of cost with me and with our team members, and we'll be definitely will be able to sit and discuss more with you. Which platforms are you offering? We have our own platform, Century Trader, which is providing you leveraged and non-leveraged facility, both of them. So you can definitely look at. Can non-Indian nationals invest in Indian ETFs? Definitely. I think if you're here, a resident in UAE, you can definitely open an investments account and buy Indian ETFs. They are just available on the exchange, so anybody can do that. Definitely. Any taxes for non-Indian nationals? No, there are no taxes because you are using ETFs and you are based here in UAE, so no taxes. I would want a session, definitely. As I said, that we can definitely sit and discuss one-on-one. So any sessions you need, we definitely have. So I've answered here all the questions. Please continue to do more. Now, moving on to a different strategy, which is called. So we discuss about one bond, which is treasury bond, right? Just real quick. So my second strategy is also on the bond, and after that I'll move on to the stocks. But my second strategy is not on the US bond; it's on a German bond, which is called Eurobuxel, which is also in a similar appearance at the moment. Now you have understood the concept that how bonds work and how a rate cut can move the prices higher. Similarly, US is not the only economy which is ready to cut rates. Germany, which is already into recession, is also expecting to do a rate cut, right? Very quickly. Here, 1 second, let me share the current flyer with you. And this is called Eurobuxel. Just 1 second. All right. Now, here is something called Eurobuxel, right? Eurobuxel is the name of a longer term, so same 25, 30 years bond, which is called T-bond ultra, right? Treasury bond ultra. There is a German government bond, and there is a basket of these long-term 25, 30 years maturity with German government bonds, which is called Eurobuxel, a basket of these bonds, which is called Eurobuxel. Again, the interest rate in Europe, 4%. Similar thing, look at the price chart. Because of the interest rate increase in Germany, in Europe, we saw the Eurobuxel prices going down from 230 to almost 130 and to 127. And last it was 127, it was in 2012, 2013 during that time. And now again it has reached to that price. So if you see, same, we have done a regression analysis, and in this case a decrease by 0.75% would lead to an increase of 15.4%. A decrease by 1.5% in interest rates can bring the price up as 30%. So this is a basket of a German government bond. So guys, see, again, this is for short-term traders. You can buy. If it goes up, you can sell it. For long-term investors, you can buy and hold on to it, wait for that price to come in. But both of these instruments are giving you an exposure. One is on US government, one is on German government, right? And Germany is one of the largest manufacturing hub in Europe. So these are the products which are linked to those kind of economies. That is why when we talk about the risk, again, these are not risk-free, relatively less riskier than day trades. But also at the same time, if the interest rate cycle changes or something doesn't go in our favor, there is an uncertainty. So we need to accept that part. And then we can diversify. Now imagine one leg into US government bonds, one leg into European government bonds, correct? So this is one more strategy which you can look into. Now I'll quickly tell you about something which we have been looking from the market perspective and from a event-based perspective also. So just 1 second again, I'll go back to my slides. And so we understood Eurobuxel, we understood US Treasury bonds. We're going to talk about something called price action analysis. Here. Okay. And let's understand, yeah. I hope everybody can see this. This is something which is, again, one of the important things. So many investors, they see, so I'll just put on 9th May right away here. So many investors, a lot of you buy stocks and hold on to it, right? Before this, we move on. A quick question over here: that what are the bank rates in Germany now? Is there a scope to reduce rates by 150 basis points? I'm so glad you asked this question. Uh, Germany right now, the deposit rates is 4%, and that is, I think, the highest it has seen in 24 years. And these are the highest rates there is in last 24 years, and that is at the time when Germany is into recession, right? So, and this was done, the rates did go up because there was high inflation across the world. It was in US, it was in Europe, it was in UK. US increased the rates, tried to control the inflation. They did, but the economy did not go into recession. Europe did the same thing. They brought inflation down a little, but at the same time, that put Germany into recession. And that is the reason why the rates right now are highest as of 24 years as we speak. The scope to for the rates to come down by 150 basis points, not this year. A June rate cut is anticipated, could be a 0.5 to 0.75% to start with. Then it depends on the inflation and how the economy goes forward, and then we could talk about. But at the end of the day, again, we have seen that 150 basis points in one shot, it doesn't happen. But 2 or 3 rate hikes from, as we speak today, from this June to the next June, that is something which is a possibility. Every central bank meeting in last 4 European central bank meetings, there has been no talk about increasing the rates, right? So this is where we have to take the hint that they are not increasing rates. It's been 4 European central bank meetings, and that is the reason that why a rate cut is anticipated by the analyst. Why they waited so much, that they're in recession and yet no rate drops? See, there are two sides to it. If they start cutting the rates, that they're scared that inflation would again go up. And if our economy is already in recession, and if that sparks inflation even more higher, because they would have increased rates more, but Germany went into recession, so they paused. They brought the inflation down, but not as per the ECB target. So I think that is the more hesitation, and I think they're just waiting to see some good numbers and some good economic data, and probably then they would cut the rates. However, as I said, that in last 3 to 4 meetings, a rate hike has not been talked about. So that's why analysts are expecting a rate cut to happen, given what is the condition of the Germany at the moment, right? So this is one product. Real quick, the third strategy, which is called price action analysis. Price action analysis is directly connected to the earning season. I don't know how many of you know about the earning season. Every stock which is listed on the stock market is obligated to disclose their financial results every 3 months: January, April, July, October, again January. And whenever they discuss these financial results, those results are compared with what Wall Street analysts have set the yardstick to. And this is revenue, earning per share, and future outlook. These three things are compared with what Wall Street analysts have expected. If these numbers are up to the expectations or outperform, the stock shoots up. If they don't outperform, the stock comes down. This has been observed throughout a lot of earnings which we have observed. And if you guys stick for another 15 minutes with me, I may be able to show you on the live platform also that how earnings create an impact on the stock prices. Now the question is this the most important time when you must trade a stock? Yes. During the earnings, the stock is capable of moving 10 to 15% depending on how much positive, how much outperformance the earnings have been, or how much earnings surprise it has come, positive and negative. The way stock can go up, it can come down also a lot. So of course the risk factor is there, but as I said, that volatility brings a lot of opportunity also. So when you're looking at the earnings result of any stock, what do you need to know? Whether this stock has how this stock has performed during previous earning seasons, right? What is the percentage movement I can expect during the day of earnings? What if I buy this stock before the earnings and hold on to it up for 1 week? What if I hold on to this stock before the earnings and hold on to it 1 month after the earnings are declared? All this information comes in price action analysis. See, I know it's a long flyer, but as I said, at this point of time, I'll explain you how it works. For more and more understanding, I'll definitely be available to all of you for one-on-one session if you wish to. The price action analysis, it takes last 10 years of the earnings quarter on quarter. So if this is a Q1 quarter, I will compare last 10 years Q1 and see that what is the probability of this particular stock going up after the earnings. And I will see last 10 years of data that how after Q1 earnings, how the stock has moved. Not just that, using the price action analysis, you can also get to know, as per this flyer, that how much percentage movement the stock could give after the earnings. So you know that what you are getting into. If you don't have this information, you would just randomly pick that stock and accept the volatility. But using the price action analysis, you get to see that what I am getting into. If this stock moves 10% after earnings as compared to last 10 years, what we have observed, then I don't want to be into this stock, or I want to be into this stock. Another most important thing, it shows you the maximum gain or the maximum loss this stock has shown after the earnings have been declared as compared to in last 10 years. So we get this exhaustive data and for all the stocks, and we try to identify using probability that what is the expectation of this particular stock beating the earnings and going higher. We are doing this for a lot of stocks, and especially during the earnings time. Today is 9th May, and just look at the stocks. Any stock, if you look at the moment, see, let's try this out. Now, for example, if you see medical properties trusting, right? I'm just picking one stock from the beginning. Medical properties trust, the last price was 4.6. The target price for Bloomberg analyst 4.9. The earnings came out before the market. Probability on up move was 51%. And the average absolute movement on the day of earnings is around 1.3%, with maximum gain being 2.8, maximum loss being 1.8. Now, if I were to look at the stock, Medical Properties Inc., for example, and you can also check if you are on internet, or if you have the access to the net at the moment, and let's see that how much Medical Properties Inc., the stock, has moved today, because the earnings has come before market, so it has already been declared. Stock price. So currently, if you see, it is down by 0.6%. I mean, you can check later also if you want to. It is down by 0.6%. So when I see this particular stock, the average absolute move after the announcement is shown 1.3%. Maximum loss 1.8% on the day of earnings. And right now it is down by 0.6%. So if you see, as compared to if you see in last 10 years, the data fits in it. The probability of an up move was 51%, could go either side. But it at least gave me an idea that maximum loss I could face is maximum 1.8%, and it is down right now by 0.6%. So volatility understanding and identifying is really important. And imagine you could screen your stocks on the basis of that, right? Question here, is this price action analysis available from you after we subscribe? Absolutely not. See, these are reports. I mean, if you want to try it out, that's why I'm showing it to you right now. These are PDFs which is available to you. You can always take it. Of course, as clients, we send it to them personally, but then you are a part of this session. You can always get these reports from your RMs, and they can definitely help you out. So this is one strategy. So everything which I'm telling you, it involves speculation, and you can land on either side of the transaction. But what we do and sit here is give you an idea that how to do it in a strategic way. You must have all the information to decide how much risk you're willing to take. Profit and loss, these are two sides of the investment. Nobody would be able to eradicate the loss, but it's only you can manage your risk well if you know how much volatility we are expecting, right? So this is one thing. Now, this is how price action analysis work. Now, real quick, I think a lot of you have given me a good amount of time, and I'm so happy to see everybody is just right here. I've not seen a single person leaving at the moment. So I'll quickly take you to my live platform and show you that trick, which I normally discuss with everyone. And, it has helped me a lot. I'm sure it will help you a lot also. Just see this. And before I share the trick, one more strategy, which is called volatility index. And I think this is one of the best things which you will see at the moment to hedge your portfolios. Just let me show you right here. I think really quick, another 5 minutes, and I'll be able to show you here. Look at this, and I don't think a lot of people are discussing about this. Volatility index is something which, so what we're discussing about is an exchange traded product, right? Hedging against market downturns. So traditional investments, as we can see, they suffer during the market swings, right? If the market is downward, how many of you are buy on stocks at the moment, or you must be buying an index and holding on to it? Something we rightly said as wicks, right? Now over here, I'm sure a lot of you are already buy on S&P, buy on stocks. What happens when stocks drop? Now, when stocks drop, you're holding on to it for a longer time, so no problem. But there is a way that if stocks are coming down, you can purchase a product which works inversely most of the time. So that is called volatility index. The volatility index, basically what it does, it measures the sentiment of the market, that how many buyers and sellers are there for the S&P 500, which is the US stock market. And on the basis of that buying and selling numbers, uh, a volatility number is generated. They single it out to a digit. And if the volatility index is going up, which means the market is expecting a lot of volatility, and at the same time we have seen there has been an inverse relationship between S&P and volatility index. Whenever the markets have crashed, the volatility index has gone up, and whenever the markets have recovered, volatility index has come down. You will be seeing this, that right now the VIX is almost at its lowest as we speak, around $13.5, and that is why it could be a good buying level which can provide you the hedge if you're already buy on the stock markets or on the S&P, right? So if you see this one, black swan events, unexpected occurrences such as geopolitical crisis, natural disasters, which can trigger market panic, right? And that time, like pandemic, if you see markets crashed and volatility index, it went up. Same happened in economic downturns, or sometimes during earnings, when the earnings are bad, the stock starts coming down. So for that, there is a product called iPath series S&P 500 VIX short-term futures ETN. Now this uh, offers you the exposure to the volatility, and so basically the volatility index has future contracts on the exchange, and these exchange based future contracts are being tracked by this particular product which I am showing it to you, right? So basically if VIX goes up, this particular product also goes up, and VIX is tracking the volatility in the S&P 500. So whatever happens, this particular product, it kind of tracks the performance of the VIX. Now, the performance is closely tied up. So, as the VIX index moves, this particular product also moves. And when we see if there's an increased volatility in the market, the ETF value also goes up. It tends to fall when market volatility is expected to decrease, right? So, this is an exchange traded note. It's an unsecured debt. Most of the traditional ETFs, if you see, they hold the assets, but this is unsecured because this is mimicking the performance of the volatility index, right? So you will see that if you don't have the volatility index on your platform, you could buy this particular exchange traded note, which is tracking the VIX clearly. Now, if you see between 2019 to 2024, 5 years, if we did around 1250 observations, and we realized that in those observations it's been 112 times when S&P has given negative returns 3 times consecutively, back on back. And out of that, 77% times we have seen that the VXS, the exchange traded note, was positive when S&P was negative consistently for 3 sessions, right? And the average return which was provided was around 2.9%. So this is also one product, friends, which is available, and you can definitely see this. Somebody asked options available on the volatility index. Yes, we can provide you options also available, not directly through our platform, but we are connected to a different platform, and we can definitely provide you the options also on these products. So this is volatility index which goes inverse the market. So today, if you feel that I don't think stock markets are going to go up, but you can't short sell them, right? You can actually, and if you have you don't want to take any leverage, you don't want to take any CFD, you can actually buy this exchange traded note which is tracking the performance of volatility index. In case if the market falls, this is expected to go up, right? This is what we have seen back in the past. So this is also another way. See how we're diversifying. We're diversifying through price action analysis, through US Treasury bonds, through European bonds, which is Eurobuxel, and now through volatility index. Like this, there are a lot of other strategies also. Now, quickly coming on my platform, and we'll end this session after this. If you have any questions, guys, please continue to ask over here. So now, when we understand a few strategies over here, let's go to the live platform and understand a very easy trick of how you can be, because this was something which was asked in the very beginning of the session, that if I don't have research, if I don't have enough knowledge, how do I do that? How do I develop that? The easiest thing, a lot of products which are being traded over here, any platform which you have, the one which I am providing you or the one which you're already using, whichever it is, try this out. What I normally do is I create a watch list, right? And let's say a watch list, I've already created one, but let's say here I've created this. Now in this watch list, I see a bunch of products. Let me open a one which is, yeah, let's say this one. Now these are a bunch of products, and the ones which are volatile, ones which I can trade daily, and then in this watch list you can throw a few other products which you can look at the long term side also. I see gold. First, gold, if you see today, as per yesterday's closing was 2308. Today it is 2331, right? It has moved at least $22 today, right? And it is up by 0.9%. Today it opened at 2309. Highest is 2339, lowest is 2305, which means it is easy to say on an average gold moves $25 to $30 a day. Which brings me to the point, somebody asked me that how to put a stop loss. For putting a stop loss, you must understand that how much on an average an instrument moves. If you buy 10 ounces of gold, you can't get a stop loss $50 down, right? Because you know that gold on a normal day may not move $50. If it moves $20, $25, you must put your take profit and stop loss within that range, right? On a much detailed session, we can always talk about then how we can use the charts to do it. But that is how you identify. Most important part is anybody who doesn't have the time to do research, all you have to do is give 20 minutes of your time. And I'll tell you how. 20-25 minutes of your time throughout the day. Dubai time, UAE time, 11 a.m. is when UK and Europe opens. Around 1 o'clock is when a lot of important data comes out for UK and Europe. Then 5:30 p.m. is UAE time when US market opens. Around 4:30 p.m. a lot of important economic data comes from US. By 12 o'clock US market closes. By 7:30 p.m. UAE time, UK and Europe market closes. All I want you to do is whenever these news comes out and whenever the market opens, I want you to glance at this list, check their highest, lowest, opening, closing, and the current price. You do this every time when, so let's say the first glance you do, if you're a morning person and you get up early in the morning, you can see Hong Kong market also. Hong Kong, by the way, at this moment has been skyrocketing. So do see from a long-term perspective if you're looking at the Chinese market. So if you're an early morning person, you can get up say 6 in the morning. However, the markets open around 3 a.m. UAE time. So I'm assuming that none of you will be there. But if you do, you start in the morning, you see, just glance to the prices when Asia opens. 11 a.m. glance to the prices when Europe and UK opens. 1 o'clock when data comes out from UK and Europe, glance at the prices. 4:30 p.m. when US data comes out, glance at the prices. US 5:30 p.m. when US market opens, glance at the prices. And before you sleep, glance at the prices. That gives you 1, 2, 3, 4, 5, 6 periods that you just have to glance. Give 5 minutes to it to understand. You do this for 10 days, a range in your mind forms, a bandwidth in your mind forms. If you go to Zara or any other store, and if you go every day and see the price of a blazer, next time when there's a discount, you will know whether it's a discount or not, because you have seen the price of that blazer throughout 10 days. So you would know whether they have put 20% off or they have actually reduced the price to 20%, because that is what you have observed. There is no chart better than your own mind. A lot of people have done this trick, and they have always come and said that, see, whenever we use or whenever we trade using this trick, it kind of gives us a understanding, because there is a bandwidth going on in your mind. Now, today I have told you that gold today highest is 2339, lowest is 2305, currently it is 2331. Yesterday it closed at 2308. Now do look at for another 10 days and observe this 5 times in a day, the entire watch list. You will be amazed to know that whenever such range breaks, so from, if I've seen observing gold from last 3 days or 5 days, and I've seen that it is not able to break 2339, next, if it goes to 2342, I know it's buy. I can be wrong, but I'll put my stop loss accordingly. That now it has broken that range, so I'll buy at 2342, keep my stop loss at 2338, because I know that if it goes below 2339, it will again trigger a downward trend. Just start with the watch list. I would never tell you to get into day trades, because it's if you're not ready for it, then it can cause a lot of risk. If you're not disciplined, if you're not putting a stop loss, if you're taking too much leverage, there are n number of ways you can lose money in day trading if you're not careful. So just practice. Take a dummy account and prepare a watch list and try to observe these instruments on the times I have told you, and come back to me and tell me what were the results. But you must do this religiously, 6 times in a day, 5 minutes, 30 minutes throughout from the day, and you will be glancing at this watch list for every 5 minutes on the time periods which I said, and you will notice the difference in your and this is how the knowledge will be developed. So I'm telling you the very organic way. I know it's a bit more studious, but I know that not all of you have. I mean, a lot of you don't have the time to look into the markets, and that's how you should do it. See it at the key moment. You don't have to be glued to your screens to understand the prices. You just have to find the key moment, the right amount, the right time when you should be doing it. Right? So, thank you so much, guys, for giving this opportunity to me to talk about these strategies and the sessions. I'll be more than happy to discuss more. I think I need a 2-hour session to discuss all the strategies with you, but I'm sure this will be a lot for you all to process. So those who are interested to know more can sign up for a one-on-one session. Just talk to your relationship managers, and I'll be available to you for a one-on-one session. If you're placed in Abu Dhabi, we have our office in Abu Dhabi, and you can definitely come. We are located at the Tamu Tower in Al Reem Island. You can come and visit us, and we have an entire team who's there. If you're in Dubai, we have office in Dubai, and we are definitely there to meet you as well. So either you can come and talk to us. And these are the sessions, because you have been a part of this webinar. So every session which we'll be conducting with you is going to be free of cost. Do not worry about it. Just come, learn, and understand. And that's how all these sessions are going to be. So once again, thank you so much, all of you. This has been a great time. If you like these sessions, please go on Century Financial Google reviews and just share your feedback. It really motivates us to keep doing more and more sessions like this. And definitely this is something which we want to do and spread more and more financial awareness to all the investors. So please put your reviews on Google Century Financials, and we'll definitely be back next week with a different topic, with a different idea. And till then, be safe, continue to trade, put your stop losses, and take care of yourself.